Alright, so this video is basically based on the accounting standard for leases, which is the IFRS 16. IFRS 16 is basically a new accounting standard, a latest accounting standard that has superseded the old accounting standard of leases, which was IAS 17. So basically, in this chapter, we'll have a quick review of what we discussed in the chapter of leases. Leases, as you can see on the screen, is nothing but a contract. So in a contract, you need to have two parties. One is lessee, the other one is the lessor. The lessee is the one who uses the asset, whereas lessor is the one who gives the asset. So since we have two parties over here, we basically will be looking at two sides of the accounting. One is the lessee accounting, the other one is the lessor accounting. First of all, let's have a discussion on what are the different types of leases. So previously, we used to have two different types of leases, which one was the finance lease and the operating lease. But now, from the lessee's perspective, in the lessee accounting, there has been a major change because now there is no such thing as the finance lease and the operating lease, and all leases will be recorded on the balance sheet of the lessee. So when the lease will be recorded on the balance sheet of the lessee, there are four things that needs to be recorded by the lessee. Number one, the right of the use of the asset. And if you're recording the asset, they also have to depreciate the asset. They have to record the lease liability and the interest liability and the interest expense. But there are a few exceptions. There are two exceptions to be specific. One is the short period lease, the other one is the low value lease. So if your lease is less than 12 months or it is a low value lease which is less than $5,000, then in that case you can use the simplified accounting of leases in the case of an exception. Now let's talk about the recording of leases, how the leases will be recorded from the initial recognition to the subsequent recognition. So as I mentioned, now all leases from the lessee's perspective will be recorded on their balance sheet. So they need to initially recognize two things in their balance sheet. One is the right to use the asset. So in the right to use the asset, there are four things that we need to include. One is the initial value of the lease liability, which is basically the present value of the minimum lease payment discounted at the implicit rate of interest. Any directly attributable cost, for example, any professional fee, any legal fee to get the lease, dismantling cost, if there is an obligation on the company to dismantle the asset at the end of the lease, and deduction of any lease incentives that is received from the lessor by the lessee. Now, that takes us to the subsequent recognition. So, as I mentioned, since we are recording the asset, we also need to depreciate the asset. So, in the case of depreciation, now the question is, what should we be using? Because there are two lives over here. One is the useful life of the asset, the other one is the lease period. So, there are two conditions. If the ownership of the asset will not be transferred to the lessee at the end of the period, then we are going to use the shorter of the useful life or the lease period. But if the ownership will transfer at the end of the lease period, then we are going to use the useful life to depreciate the asset. Then there are some exception situations as well, that if you are recording the asset as the property, plant and equipment, and you're following the revaluation model, then in that case IAS 16 revaluation model, property, plant and equipment will apply, where gain goes to the other comprehensive income and the losses goes to the P&L. But if it is the investment property, then you have to follow the fair value model if you wish to follow. If you're not following the cost model, and the fair value model of IAS 40 will apply, where all the changes goes to the profit and loss. As far as the lease liability is concerned, there will be two changes in the lease liability. One is the interest expense, which is going to increase my liability, and the other one is the cash paid, which is going to reduce my liability. So this is going to be the normal accounting treatment for the asset and the liability related to the leases. Now there is a simplified lease as well, which I told you that it can be either less than 12 months or a low value asset. In this case, the working will be absolutely same of what we previously were doing with the name of the operating lease, where we were spreading the expense on a straight line basis over the lease period, irrespective of whatever the payment periods were. Now, For the lease liability, guys, we have to prepare something with the name of lease amortization schedule, which can be prepared in two ways. One, as you can see on the screen, in areas where the installment is paid at the end of the year, and the other one in advance where the installment is paid in the start of the year. Now, whenever we will be doing the working from the presentation perspective, we have to always reflect the lease liability as the current and the non-current amount. So what we have to do is we always need to prepare one extra year in the lease amortization schedule, and the difference between the outstanding balance of this year and the next year will be considered as the current liability, and the outstanding balance of the next year will be considered as my non-current liability. But when you're doing the working with advance, you have to be careful. You do not have to accrue the interest of the next year, because since the liability has not yet incurred, the event has not yet taken place, we are not going to accrue the interest of the next year. And as far as the simplified lease is concerned, a simple double entry would be recorded, which is the expense debit cash credit on a straight line basis. Now, from before I move into the sale and lease back, one thing which is important from the lessor's perspective, from the lesser accounting perspective, there has been no change, and the lesser accounting is absolutely the same as it was before, where we still have the finance lease and the operating lease using the same rules. So I gave you the certain rules to identify how to classify a lease as a finance and the operating lease. So finance lease is that lease where the risk and rewards are transferred, whereas the operating lease is the lease where the risk and rewards are not transferred. In the finance lease, the lessor will be recording only the lease receivable and the interest income, whereas in the operating lease, the asset still remains in the books of the lessor. He depreciates it and record rental income on a straight line basis. Now, the important thing to consider over here is the sale and lease back, where the lessee is selling the asset and they're leasing it back. So now we need to identify over here that what is the situation if this transaction is a genuine sale or not. So if it is not a genuine sale, the asset remains in the books of the lessee, and the lessee records the amount of cash that he has received as a simple financial liability. But if the transfer of the asset is qualifying as a sale according to the rules of IFRS 15 revenue from contracts with customer, then you need to see what part of asset you have retained and what part of asset you have transferred, and record the transaction according to each of the individual part of the asset. So at the start of the lease, you're going to debit the lease asset and credit the owned property to remove the asset from PPE and record it as a lease asset. And then for the transfer of the asset, you debit the complete proceeds with the cash. The owned property is going to be credited with that part of the asset which has been removed from your books. Gain only on that part of the asset will be recorded, and lease liability will also be recorded accordingly, equal to the present value of the future lease payments. That's it for the revision for the purpose of the IFRS 16 leases.